Hi, I'm Ross from Lifetime Property Accounting, and we're just going to go through a quick example of what cash flow is. So, just looking through Facebook, I just saw an advert come up, a property for sale for 8.5% gross yield. So, straight away, 8.5% gross yield, we start thinking that is reasonable. And unfortunately, the first thing that comes to my mind is there something wrong with it? Is it actually realistic? How will it work out? So, this was a Facebook advert or advertising on Facebook. So I don't want to share it because that's a bit unfair, but I'll give the basic information. It was Dunedin, 8.5% gross yield or more, three bedrooms under 400,000. No, we're not selling this property. I'm not trying to sell you anything. It's just an example so that we can go through the cash flow and let's see what the numbers look like. So when we start looking at our numbers, we've got 400,000. Obviously, it costs you when you're looking to buy a property. You're going to incur legal fees. You're probably going to get a valuation, a building inspection. It costs you money, maybe about $5,000. You're then likely to get a cash contribution from the bank. So just being a little bit conservative, let's say you get 3,000 back from the bank. I always work on 100% debt. So if you've got cash, you want to return on that money. So what I do to start with is work on 100% debt because it factors in a return on your money, and then it gives you a true picture. How good is this rental? And we always get the question or the comment, you can't borrow 100%. Well, most property investors do borrow 100%. They borrow using security gains, personal home, or other rental assets. So, yeah, generally they will borrow however much they can from buying this property and then borrow the extra amount from another property. So they do borrow 100%. This property, it was saying 8.5% gross yield. So I've done it on 50 weeks just to make an easy calculation. You'd need $680 a week roundabout to get the 8.5%. Let's be nice. Let's make it 685. So we're just over that 8.5% gross yield. So this property would have to receive $685 a week for 50 weeks. Yeah, on a $400,000 property. So straight away, I would be very suspicious about this. And if we seriously looked at it with due diligence, I would be looking at what's the catch? How is there so much rent on a property under 400,000? Is it leasehold? Is it rent by room? Is it Airbnb? What's the catch? What's the reason? Because that is going to change it a lot. So, obviously, you'd be chatting to a couple of property managers, checking what is the long-term sustainable rent? Can you get $685 on a three bedroom property under 400,000 in Dunedin? We don't know what the property is, so none of us actually know what that answer is, because we don't have the exact details. Then, if this is your first investment property, you're going to spend more on accounting. So accounting only goes up a small amount as you add extra properties. It's a lot more expensive per property for the first one because you're getting more advice. You're doing the full financial statements for the entity, and yeah, generally goes up about $200 as you add each property onto it. Insurance, stock standards insurance, somewhere around $1,800. This could be a body corporate or something. I don't know. Let's presume it's not. Yeah, insurance, $1,800. Interest rates have just jumped up. We were 4.6% a few days ago. Now we're probably 5% for a standard 1 year rate at the moment, and potentially that could go up. I've got property management in there. In my standard, I've got it at 8%. So yeah, we're working on 8% property management in there. Rates, don't know the exact property, but low value, maybe 2.5. And generally a cheaper property, higher repairs. Yeah, it depends exactly what it is, but most likely you've got an older property, needs repairs. Presuming it's in a good condition to start with, we're looking maybe $3,000 a year as a quick guessing point without knowing the property, 30,000 over the next 10 years, because it's a relatively probably small, cheap property. So yeah, quick numbers, what we're looking at this, we're generally looking 8.52% gross yield. We're thinking that's reasonably good, 34,000 income in. But we're also looking at maybe 33,000 expenses out. If you're out of town, so I'm not in Dunedin, it's going to cost me a travel down there once a year. Yeah, I'm looking at basically 34,000 income, 34 expenses. I'm basically break even. I've got 444 cash flow positive with 100% debt, and that is interest only. I don't have principal in there. From a tax point of view, you then get a chattels depreciation done. Low value property likely to have lower level of chattels. We always recommend value. It's not because I get a kickback or I've got shares or it's my business or anything like that. It's just because they're the only ones who actually know what they're doing for chattels valuations. They maximize the depreciation. They're going to do way better job than you trying to make it up yourself. It's pretty much impossible. They're going to do much better than a normal land value. And you, like I say, haven't seen anyone else do a good job. So for the cash flow 444 net profit for 1 year. Least depreciation, losing so the about 2,500 for tax purposes. Won't be paying tax because we're not making any profit under current tax rules. So to me, probably the main thing with this is like I'm a little bit dubious. I'm wondering what is the catch with the 8.52% gross yield. Is that realistic? I'd love to see what is this property? What does it really look like? What's the catch with it? But overall, it shows how quick that disappears. 34,000. And 34 out, it's basically break even. So it's still like if this was a good property, good location, neutral cash flow is actually fine. But I'd just be worried about this. Is there something like, is it an apartment in Dunedin? Might not be that big a demand. Is it leasehold? Is there something which is going to reduce your potential gains from it? And if you're not really making any cash, you obviously need to make sure there's some long-term potential for capital gains or some initial equity created. So yeah, interesting. Potentially as a first buy, worth looking at further, something like this and exploring for. But like I say, just be a bit cautious what it could be. And yeah, interesting that the cash flow doesn't work out amazing once you've gone through that. Well, hopefully you've found that enjoyable and got something from it. Thanks a lot. Bye.